Good morning, everyone. Thank you for joining in today. Uh, is my screen visible? All right, thank you. Um, thank you for joining in today. What we're going to be talking about is the NRI investment opportunity. And what we felt is that generally the communication that happens for NRIs relating to investing in India is always that we tend to bucket all NRIs into the same category, right? Whereas quite often, depending on where you're located, there are so many other factors that you'd like to take into consideration. And two of the top things are generally currency as well as taxation. But there are certain other things as well, right? Depending on where you are, the kind of savings vehicles that you have access to changes. Each person may have a different approach to being an NRI and may have different goals for themselves over the course of their careers. So, taking all of this into consideration, what we've done is we've tried to curate webinars that address people at a regional level so that we can have a more focused and productive conversation. We'd really encourage you to participate in Q&A with us towards the end of the session. I will be walking you through the NRI investment opportunity, and we'll have an interactive Q&A at the end. You could type in your questions or in the Q&A section or on the chat box, and I'll be happy to take that um, at the end. Thank you once again for joining in. And without much ado, I will begin the presentation. So to begin with, I want to talk about what kind of year 2023 is going to be. We've been saying that it's going to be a year that belongs to savers, right? And there's a lot of merit in forming this view because firstly, what we're seeing on a market perspective is that the market is going to be extremely volatile this year. There's so much, even monetary policy is going to be data driven, right? So central banks are saying that today we are not going to just follow a particular trajectory that we've set. We don't have a path that we're walking on. We're literally going to go from meeting to meeting, look at the data, and then take a call. We're also seeing this reflect in equity markets where there's a divergence in opinion as to how things are going to play out. And by and large, investors typically tend to look at volatility as a negative thing. But volatility can actually be really good because when there is volatility, there is a change in valuation. When there is a change in valuation, there is an opportunity for every saver and investor to act. So, being prepared for your actions when the market moves in a particular direction is what every investor really needs to focus on today. But that being said, we are in an era of wait and watch investing, right? Just like how central banks feel that they have to take decisions meeting to meeting, they need to watch out for data. I think there is some merit in being cautious and being patient and going slow with your investment trajectory. So, whether that's in terms of contributing month on month or following a very wait and approach investing strategy where you're staggering your entry, where you're staggering your exits, but being prepared to act at every opportunity. Now, the next thing is that we need to differentiate the years in the market because most people seem to think that the market cycle is more linear, but it's actually very cyclical, right? So people tend to think that, okay, if my portfolio is doing badly, it's going to continue to do badly, and there's not much that this is not the time for me to give it any attention. And they think that when their portfolios are doing well, that's the time to sort of scale up their investment and act more on decisions. But uh, investing in the market is kind of like farming. So you will have a season to sow and you will have a season to reap. And when you're sowing, it's going to be a boring market. You're not going to see any results from your actions, but you've got to keep doing the work. And then eventually you will get to a harvest season where you can actually reap the benefits of what you have done in the years where you are constructing your portfolio. Now, the same thing teaches us that valuations and risk actually move in the same direction, which essentially means that uh, when I see performance, the risk is also increasing in that particular idea, right? And when I see underperformance, the risk in that particular idea has actually reduced compared to how much it was previously. Now, because valuations and risk move in the same direction, the smart investor knows that when there's underperformance is when they should start looking at more portfolio actions. And when there is overperformance, they should start looking at reducing risk, right? So this slight change in mentality is really going to help every saver get better at creating wealth. And with that mentality, you can actually outperform, because when you see a correction in valuations, which will be a result of volatility, you can outperform by scaling up when the chips are down. And that is what 2023 is going to offer to savers. It's going to give you tons of opportunities. You're going to be spoiled for choice across asset classes. It's not just about equity. You have opportunities in fixed income. Gold has moved to a much higher level today than it was a few months ago. So, being patient and seeing where the market takes us and what asset classes will be attractive is something that we can definitely look at. So, there is something for every investor in 2023. And it's not often that we get a year like this, right? Usually, it's always a year that belongs to one asset class or the other. This is a year where every investor, regardless of their risk profile, can participate. So now, moving on to saving in the UK, I think when it comes to saving in the UK, there are three popular options. One is the ISA or your individual savings account. You also have the workplace pension scheme, and you have the self-invested pension, personal pension. So you have the ISA, the workplace pension scheme, and the SIPP. Now, these are all longer term savings vehicle, predominantly fixed income oriented. And the key differentiation between these products is that the ISA is a post-tax contribution. So you're contributing to that account after you've paid tax, which essentially means that at the time of withdrawal, whatever you take out of your ISA is tax-free. Similarly, your workplace pension scheme is something that varies from employer to employer. So those are products that you need to review at an individual level with an advisor or your financial planner. And the SIPP is a pre-tax contribution, right? So it's an option to defer tax, which essentially means that today whatever you're earning is allowed to compound over a period of time, and at the time of withdrawal only you pay tax. Now each of these have their own advantages, and these are powerful savings vehicles. But NRIs also have certain other opportunities, right? So let's look at some of the popular investments that NRIs actually make use of. So the first and the top option is broadly NRE and FCNR deposits. These are issued by banks. You also have whole life plans and annuities, which we've seen broadly in many asset allocations. And then real estate is a big favorite. And one of the ideas that's picking up a lot of steam in the UK is, as well as Europe, is ESG investing, as well as investing in global equities. Now, I'll be covering each of these products in slightly more detail. So firstly, talking about NRE and FCNR deposits, right? In India, the interest that you earn on these deposits is tax-free. So you don't actually have to pay any tax on either NRE or FCNR deposits in India. So the difference here is that the FCNR deposit is a fixed deposit that you do with GBP as the denomination. So you're not doing any currency conversion here. Whereas the NRE account is an INR based deposit, which means you would have to convert your UK income into INR before you make that investment. And roughly the return rates on these on your FCNR deposit is at 4.7% today, and your NRE deposit for 1 year is close to 7%, right? And comparatively, if we look at what your bank rates in the UK are, that's closer to 3.5%. So this is the key sort of difference. So clearly there's like a 1% arbitrage in doing an FCNR deposit over a UK bank deposit. And you're also in a period of higher inflation, right? So given where you are in the cycle, every extra percent at no additional risk really does make a difference. So now talking about whole life policies, which have been a big favorite. Essentially, what a whole life policy does is, regardless of when you buy that policy, it covers you for the entire period of your life. And there is a payout that goes to your named beneficiary. So that could be a partner, it could be your child, or anybody else who you have named as your beneficiary. But when is it that people actually need to be insured? You need to be insured only during your working years. Because by the time you hit the retirement milestone, you already have a retirement corpus in place, and that should provide for any dependents that you have. That's the whole purpose of saving and planning and, working towards retirement savings. So, whole life, essentially, the premiums are going to be significantly more expensive than a term life policy. What we've seen in other products, which are endowments as well as ULIPs, is that they offer some kind of return to compensate for the higher premiums. But essentially, the returns don't work out to be very attractive. In most cases, you would be better off with a fixed deposit due to the layers of fees as well as the time value of money that is involved in these products. So, whole life in general is not going to work. If you need to get the kind of cover that you need with a whole life policy, your premiums are going to be much, much more expensive compared to term life. So this is one thing that investors should look at reviewing and understanding whether it's actually doing its job for you or not. Moving on to annuity, there are a few limitations. Of course, the key advantage is that you get money month on month, and that's guaranteed, and it's for the duration of your life, and that essentially means that your retirement years can be spent in peace. But I think the lesson from 2021, 2022 is that inflation can be extremely unpredictable, and if you have a period of high inflation, it's not going to come back to a normal level very quickly. We've already spent 1 year in tighter monetary policy, and you're still seeing extremely high inflation prints. The next thing is, if you're a younger person and you're looking at buying an annuity, you don't even know what your lifestyle is going to be like at retirement, right? We're not able to predict what is the exact amount of money that you would need. So when you're closer to retirement, having some portion of your savings within an annuity product gives you some stability in terms of monthly income. But if you're a younger person, locking into an annuity product may not actually make sense for you. So when you buy an annuity, what you're doing is you're paying the insurance company a large sum of money, which they will manage, and you will get an annuity out of that. So you're essentially giving up control of a portion of your retirement corpus, and that is something you need to ask whether you want to do that or not, because essentially you will not have any flexibility in adjusting the investment strategy to generate higher income if you enter into a period of higher inflation. You would not, or if you need more income at a later point in your retirement, right? Let's say you have medical complications and you want a higher income stream. That limitation is there with an annuity because you don't have any flexibility in changing what you receive. And most annuity products are high cost products. So being cost conscious when you're choosing these makes sense. So always review this with your advisor, with your financial planner, to ensure that you're locking into the best products at the best time for yourself. Now, talking about real estate, there are some issues that are very realistic, right? So when it comes to home loans, we've had almost uh, 10-15 years of extremely low interest rates. And now you're seeing at a global level, interest rates are moving up. In India, in 2020, your home loan rates were significantly lower. Today, you're looking at a home loan of 10% upwards. Your physical upkeep and maintenance. So if you're in the UK and you're buying properties in India, you have to spend a lot of time and energy in just managing these properties. So whether it's finding tenants, whether it's paying for maintenance and upgrading the property, all of this actually eats into your time and financial resources. So that's something that most people don't consider, or they tend to ignore these costs that are associated with this, right? And of course, depending on what the tax regulations are. There might be implications for any rental income that you earn, or when you dispose an asset, whether you'd have to pay tax in the UK in addition to paying tax here. And from a very practical perspective, entering and exiting real estate takes a long time. So you might decide to sell your property today, but it could take 6 to 12 months before that actually goes through. You might have to schedule a couple of visits to India to ensure that it happens, or you might have to delegate this to somebody else in the family to take care of. So the exit is not going to be as smooth, right? Which is why considering financial assets makes sense, because the liquidity, the exit, the entry might be easier from your perspective. And when it comes to ESG investing, I think there are three things, right? When you look at ESG, you're talking about ethical, social, and governance. So, what is your objective? Because very rarely are you going to find an investment that actually ticks all three boxes. So, knowing what your objective is and what you're trying to reach would help you identify opportunities in a much faster and efficient manner. You also need to study the label. A lot of the times, you will come across a fund that's called socially responsible, or you will come across any label that sounds like, let's say you're interested in the theme of water conservation. So you might come across something that's an aqua fund, right? So then you actually, the label kind of indicates something to you, but when you look at the product and you look at the companies that are within that space, how much of it is actually meeting your objective? They're not always labeled as ESG funds, but you need to look at whether this is any different from another fund or not. Because then you can evaluate on a more objective basis whether this fund actually is going to outperform something else that doesn't have the same label. And you need to be aware of greenwashing, because this is something that you're seeing happen. And most investors feel upset about this once they've made an investment and they realize that it's not matching up to what their intentions originally were. So being a little bit more cautious and prepared, as well as conscious of what you're doing in this process, would really help you find the right products. So now moving on to global investments, right? So I think today where we are, there is a lot of fear in the market. There is a lot of fear in how things are going to pan out. The economic outlook is weak. You've been seeing the IMF cut down on global growth forecasts. You've also seen a banking crisis unravel over the last few months. So you've had three banks in the US sort of default. Then you've had Credit Suisse, which was sorry, UBS, which took over Credit Suisse. So this is something that we could either decide to view as isolated events, or we could see this as a symptom of a larger trend, which is yet to fully play out. And I think the more prudent one would be to think of this as a story that is not fully written yet, right? There are still chapters that are pending, and we'll have to wait and see what appears in those chapters. And when it comes to inflation, I think this is the first time in a lot of advanced economies where you're seeing even double-digit inflation. Yes, on the US side, inflation is coming closer to target, but it's still well above your target. In the UK as well, there is almost a 6-month lag between US trends and UK trends. So when you're in a period of high inflation, you can expect corporate profitability to decline, which puts pressures on margins, on valuations, and could actually dampen the economic activity as well as performance, right? And as a resident in the UK, you also need to consider the layered currency risk. So if you're investing in a product that is based out of another geography and that has a different currency, then you need to look at all of the currency transactions that happen in between. So usually the route to invest in other economies has been through active funds, and most of these funds have very high expense ratios, which would essentially eat into your returns. And honestly, in the global market scenario, like you would see that the returns have not even been that promising over the last 5 years. That's something that I will walk you through shortly. And today's context, so most investors might think that, okay, let me get out of active because I am cost conscious and I don't want to pay such a high expense on an investment. But today we really don't have the uh, bandwidth for passive management because there's so much volatility, there's so much necessity to respond to opportunities that probably a passive product is not going to do as well as an active product that is well managed. So looking at currency risk, I think this is the one thing that most investors think about, right? Like when they are looking at global investments, whether it's India or elsewhere, the first thing that comes to mind is what is my currency risk? And the next thing is probably about tax. So when it comes to currency risk, you need to minimize layers. So for instance, let's say you're familiar with mutual fund investments in India and you like the Nasdaq, right? So as a UK investor, are you going to buy a fund of fund or a global fund from India? Because then you have three layers of currency risk, right? Because you're looking at pound to INR, then you're looking at INR to US dollars, and then you're looking at the reverse when you exit. So all of these currency transactions are actually going to have some impact on what your final return is, right? And you want to minimize the layers because each layer is actually bringing a certain level of unpredictability. It's difficult to determine exactly what this is going to be. You also need to monitor macro risks, right? This is basically the key thing that drives the currency valuation is how a country's macros are performing. And the easiest way to sort of manage currency risk is to be clear about your currency goal alignment. So if you're a UK based NRI and you know that you're coming back to India to retire, then you must have assets in India so that you have INR based assets that would take care of your INR needs post retirement, right? If you're a UK based investor and you're not sure where you're going to retire, you should have assets in both countries. But if you know that you are going to retire in the UK, then your India allocation is basically your emerging market allocation. And we'll talk about whether every investor needs to look at India or not. But this is broadly how you need to think about things. Or if you invest, then have across the board, like depending on where you want your life to take you, you need to have your investment structured in such a way that takes advantage of those locations. So what is the global investment opportunity like? We've looked at the performance. We wanted to compare the performance of three indices starting, say, 2018 until 2023. And when we took out the data, so the green line is essentially the Nifty 50, which is an Indian index. The gray line is your MSCI World Index, which is a global index. And then you have the FTSE, which is UK based, right? So if we look at this 5 years, right, there's been an 80% performance, almost 75 to 80% absolute return on the Nifty 50. Whereas on the world index, there's only been a 20% absolute gain, roughly. And the UK index has actually gone nowhere. You've, in fact, made a slightly negative return in this time frame. So clearly, there is merit in looking outside of the UK, firstly at a global level and also at an India level. And when we talk about looking outside, the first sort of hesitation is what about tax, right? So you need to check for an existing double tax avoidance agreement, which between India and the UK, there is a strong agreement. So the DTAA ensures that you only end up paying one tax rate. And with India and the UK, you get a tax credit. UK residents get a tax credit based on whatever the tax differential rates are. So the residual tax, let's say tax in the UK is 15% and tax in India is 10%, then you pay 10% in India and 5% is the residual that you will have to pay in the UK. You don't pay 10% in India and then 15% in the UK. So this kind of DTA really gives you a lot of freedom to look at Indian investments. And one of the best practices is that you file income tax returns in India, even if you don't have any income or any assets, because eventually, if you are considering something, you would have a continuity in terms of your record and ensure that everything is, in place. So now coming to the India story, why is it that UK-based NRI should really be looking at India as an investment destination? So while everybody's talking about a global recession, and in India we're only still talking about growth, right? We're not talking about deep system. So global crisis. But in India, we have our banks are stronger than ever before. We have cleaner balance sheets. They're ready to lend. Uh, and that is going to be one of the key drivers for economic growth. On the second parameter, we have flows. So for the last few years, our FII investments and FDI investments have just shot up like crazy. So globally, investors are looking at India as a destination. And unlike previous years where hot money would come in and go out, and there would be a lot of fluctuation in terms of market valuations, in terms of currency, I think India has come out much stronger in the last few years because the RBI has shored up a lot of forex reserves. We've had excess FII outflows in 2022, and we've weathered all of that without the index or the currency really losing too much, right? So whatever we thought about how India worked in the past, like clearly there's a break and things are changing today. And from a currency perspective also, between India and the euro, like you've seen, like somewhere between India and the advanced economies, your currency depreciation is in the range of 3 to 5%, right? And given that most advanced economies are going through a higher inflation cycle than India is, you could actually see some change in that trend. So we know that the dollar had a very strong year last year. Um, and that reversal is happening because there needs to be some kind of mean reversion. It may not happen immediately, it may take some more time to play out, but you can't have an overvalued currency for too long, right? And on the interest rate side, I think if we look at the FCNR deposit, we are at 7%. Sorry, at the NRE deposit, we are at 7%. So there's a good differential between what you would get in the UK and what you're getting here. We're also closer to the peak of the interest rate cycle because where we stand today, a large part of the inflation worries are getting managed, but it is still very much a wait and watch scenario because you could have um, a commodity price change. We've seen that overnight when OPEC decided that they would issue production cuts, oil prices just rose overnight, right? So there's so many things and there are so many moving parts that you don't want to take anything for granted. But given everything, broadly, India is in a very strong position to be an investment destination. You have resilient markets, you have resilient flows, you have growth on your side. So a lot of things are looking brighter, and India is the bright spot in the global market today. So what is a good asset? I think this is a question that all investors want to ask at some point. Where should I put my money? Should I put it in gold? Should I put it in equity? Should I be in global markets? And the thing is, there is no such thing as a good asset and there is no such thing as a bad asset. Because I would like to bring your attention to a couple of ideas in this chart, right? Look at the top three positions across the last 12 years, like from 2010 to 2022. You won't see anything being in the top three for more than 3 years. So every few years, there is a change in the cycle. Whatever you think is your top performer will not be a top performer forever, right? And because this happens, I think we also need to look at how quickly winners can become losers. So let's just look at gold from 2017 till 2022. In 2017, it was at the bottom of the pile, right? And then between 2018 and 2020, it was one of the top performing assets. Then we come back to 2021, where it was the worst investment of the year by and large. And then in 2022, it's the top of the pile again, right? So this is what we need to learn as investors. You don't want to get into an investment. So in 2021, nobody was really everybody was talking about gold. In 2022, nobody was talking about gold. In 2023, again, after it's crossed the $2,000 per ounce mark, you're hearing people talk about gold. So you need to actually be in a performing asset class before it performs so that you can capture performance. And because the winner of every cycle keeps changing, you need to be more dynamic in your approach of selecting products, selecting asset classes, and working with an asset mosaic, because each market cycle, each phase of the market cycle, asset classes will behave differently from each other. So a combination always tends to work better than looking at just one asset class and hoping that it will do the trick across, all of eternity. So what is it that NRIs really want? I think there are just four things that NRIs want. You want to create wealth sustainably. You want to invest in products that allow you to scale up, right? Meaning, if you want to continuously contribute and grow, like you don't want that hassle of finding a new product every time. You want to minimize your currency risks with respect to your India allocations, and you definitely want to achieve your financial goals. And this is exactly where SPHERE comes in, right? Because we have an asset allocation approach, which essentially ensures that we are participating in different asset classes through the market cycle. The kind of underlying securities that are there in the NIO portfolio are liquid and suitable for consistent contribution. So if you want to add into your portfolio month on month, that is something that NIO can take in, absorb, and deliver on performance for you. This is a product that we've actually curated exclusively for NRIs. NIO actually stands for the NRI Investment Opportunity, and this is solely for NRI investors. And every investor would like to have their world of investments in one place, right? You don't want to have 20 different products that are doing 20 different things for you. You would much rather have one product that does 20 different things for you. And that's exactly what NIO aspires to achieve. So what makes us special? This is 12 years of product development that has gone into building NIO. And what that means is we've not done some back testing. This is not a hypothetical portfolio that we've constructed. We've done real-time performance validation in understanding what works, how to look at asset allocation, how to play these lateral shifts between asset classes across different years in the market. And that uh, the grounding in reality and in the market is what makes NIO stand out from the other products that are available to investors. So now let me take you through our way of investing, right? I think by and large for an investor, uh, being a NIO would be a long-term journey. Now I'm going to walk you through one of the themes that we played. In 2017, the market was crazy about mid and small caps, right? At that point, we started looking at pharma because it had corrected from its 2015 highs uh, quite a bit, almost by 50%. And at that point, we felt that this sector is attractively valued, but we also knew that it was going to be a long-term journey, right? Because once a sector corrects, or once you have a thematic idea, this could take years to play out. And for an investor who stayed with us during that time, right, it could have been very frustrating if you were the kind of investor who was measuring performance, because we bought so this was played through a mutual fund. So I'm just going to take you through roughly what the NAVs were when we purchased. So at around 90 rupees was the first time that we bought. Then when it moved up a little bit to say 93, 94, we were buying again. Then for a whole year it didn't do anything, and then in July, so roughly 6 months later, again we bought around 90 rupees. Then 1 year later, again we bought at 90 rupees. So for an investor, it would have been like, what are you doing, right? Like I've made no return in the last 1 year and I've been consistently investing. But from our perspective, because we only look at valuations, right? The valuation was extremely good at that point, and we still felt it was attractively valued. Then 1 year further down in 2019, mid of 2019, again we were buying below cost. So at this point, for an investor who measures performance alone, it can seem like this decision is not a good decision, right? But for us, what we saw was what could happen on the right side. We did expect that that journey would take longer. We didn't expect
What
it to
is
happen
the
so quickly
network
within
effect?
1 year.
Let
I think COVID was what compressed that exit
me
journey.
help
But
you
normally
understand.
the exit also is much more staggered. We thought it would take another year or so for the full performance potential to be reached. And so you can see just the way we staggered our entry, we've also staggered our exit. And that's the kind of approach that we'd be taking today as well. And this entire journey was 3.5 years. So you got to stick through that really boring and painful part of
What
roughly
is
one and a
the
half or
network
two and a
effect?
half years
Let me
before you
help
get
you
to the
understand
exciting
this
part of
with an
another 1 to
example.
2 years. So, what is it that Sphere Neo can do for you? I think it can help you create wealth sustainably. It can protect you from tough market conditions because of the asset allocation approach that's there in the portfolio. It can make your investment portfolio more versatile because we're looking at multi asset within India and some global exposure if there is any need to take that. It also allows you to align your portfolio with your goals. Um, and helps you get your India asset allocation right. So this is essentially what Neo can do. And now I'll talk about what every investor can do to win, right? So you need to be patient with themes. We just looked at how pharma took so long to play out, but the patient investor actually was rewarded the most. The next thing is that we need to be in the right asset at the right time in the right place. So when we looked at that asset mosaic, we saw that if you want to be at the right asset at the right time, you need to be a little bit earlier. Because once you come in when there's performance, you're not going to get the same result as you expect. You also need to engage with opportunities. So at the start of the conversation today, I talked about how we can scale up when the chips are down, right? So whenever opportunity knocks on your door, there is a way for you to respond to that opportunity, and grabbing it is what is going to help you outperform. You also need to be consistent with your contribution. We do believe that 2023 is a year where slow and steady is going to win the race. And every investor needs a target to align themselves to. So it could be your financial goal, it could be a target that you're setting for yourself, it could be an aspiration. So, whatever it is, that anchor is what is going to give us direction in a market when the market is boring or when the market is not being conducive to our own aspirations and desires. So with that, I just want to show you our portfolio performance. Um, this is a product that we began only in October last year. Um, but we did have an RIA practice that was around for more than a decade before we ideated on Sphere Neo. And that has been the foundation for our product. And now I'll just open it up for questions. So you can type any questions that you have in the Q&A section or in the chat box, and I'll be happy to take that. Yes, the minimum investment for Sphere is 50 lakhs by SEBI regulation because it's a portfolio management service. problem, sir. Thank you for your question. All right. So if we don't have any further questions, we can end the meeting. Thank you for joining us in today. Oh, I see somebody's typing. Is the audio clear for everybody else? Okay, sorry, sir. I'm not sure, but I think there will be a recording available after the event, so we can send that across. And you could always reach out to us. All right. So I guess there are no further questions, and I'll be happy to connect with you, sir, one-on-one after the webinar. And thank you, everybody, for joining in today. I'll just shortly end the meeting.